Hi, greetings, everyone. My name's Dr. Thaon Simms. Welcome to the Limitless Podcast. Joining us, as always, is your co-host, Dr. Matthew Preston. Hail at the people, I'm Matthew.
Hey guys, what's good?
And Dr. Doom returns. Yes. Yo, Preston, you put the Dr. Doom in the bracket. I'm literally just seeing that right now.
Nah, he did that.
He did that? Okay.
Yeah.
Greetings, Julian. This is Julian Morrison, everyone. Julian is no stranger to the podcast. I think you've done quite a few episodes with us already. So just welcome back.
Yeah, man. Thanks for having me. It's really great being here, and I appreciate the platform and the conversation.
Blessings, bro. Blessings.
Mhm.
I mean, he appreciates it so much. It is 9:10 p.m. and he's still at
Past
work.
our bedtime.
Way past our bedtime. But, Julian really has been tried. And we've been trying to get him on the podcast for quite some time, but this proves his dedication. So thank you, Julian. We really appreciate it. So for the title of this episode, I mean, we haven't really fully thought of the title yet, Preston, but we're going along the lines of discussing very topical things that we've been seeing on Twitter a
Dun, dun,
lot.
dun.
We've been seeing just in the financial space all over, right? It's not a new conversation, and it's definitely won't stop for now. I don't see it ever stopping.
Almost every day in those different Telegram groups, I see someone mention it. Rights issue, APO. So I thought we've been planning this for a while. We're like, yo, people are just talking about this all the time. Let's talk about it, and let's talk about it with someone in the industry.
Exactly, and I've never seen somebody talk about both of them. Like, you see the discourse, but I've never seen like maybe a video or somebody actually like proper conversations. I guess just over audio. It's more just text and people defending it very strongly. So we have Julian Morrison. You're in the industry, Julian. Talk to us. I know the broad heading for both is like secondary offers. Is that it? So I guess we should just break down rights issue, what a rights issue is and what an APO is.
Well, actually, I'd go even further back to talk about fundraising, like why do companies raise money? So you share your thoughts and I will fill in. So tell me why you think companies raise money.
Okay, yeah, just our reasoning. So when I first started investing, right, the first thing I knew of was an IPO. And in that IPO, there were plans by the company. They literally tell you their plans. So they really want shareholders, and they're selling piece of the company, their shares, and they're getting money. They're getting funds. And a lot of those companies use those funds to either, invest in the company, pay down debt, maybe acquire a new business, all sorts of different things that they can use money for. So that's why companies raise money in the first place.
Doing it to grow the business, essentially. And then they have different ways that they're planning, different ways they can grow the business.
Yeah, so what I say to add to what you shared is that we can remember the cash flow statement. So there is cash flow from operations that shows us how much cash a business is generating from its operating activities, buying and selling goods to generate a profit or offering a service to generate a profit. Then there's cash flow from investing activities to show how much a business is allocating in terms of cash towards its expansion of its asset base. So is it that the company is buying more property, plant, and equipment, which is fixed assets? So land, equipment, anything that has to do with productive capacity goes in investing activity. And sometimes acquisitions go there because that's a part of the company's asset base. Then finally, there is the financing cash flow, which is a means by which the first two avenues are financed because they have to be financed. So are we financing with debt or are we financing with equity? So that's to set the conversation within the right framework, because we work with frameworks. So pretty much companies can either invite other investors to come in as shareholders to invest alongside them. When we say companies, we mean management. Typically, this is in the case of founders who might have been in the business since inception, or a second generation founder who took over from a parent, a patriarch or a matriarch that might have started the business. So let's think about it a little bit more so it can be intuitive. We're in a country where equity is hard to get. Equity is not easy to get. It's hard to get. Anyone who starts a business will understand how hard it is to get equity in the form of investments relative to debt. Most persons want to give you a loan. Part of it is cultural, because in the 90s, many equity investments went under. A lot of persons got burned by real estate deals that went bad, or they had stocks that literally lost their value overnight because of FinSac and many other things. And of course, many investments were branded as such, but were probably a part of an unstable pyramid structure in the case of Olint. So what that has done is caused many persons who have had capital over the years to become more risk averse. So all of that plays into the fact that equity is not easy to get. So many investors who might even be interested in a business model, they prefer to give you a loan. So what we found is that many business owners have had to borrow more than they need to, or what would be ideal, because every business model has an ideal funding mix. There are some business models that are built to take more debt than others. But because of the landscape that we're in, what we found is that there are many businesses that might be decent from an operational standpoint, but they have the wrong financing mix because of how scarce equity is to get. Even getting private equity investment, that is an equity injection, or persons buying shares in the business that is not listed on an exchange, persons coming in as shareholders, that's not easy to get. And a lot of that money is from friends and family, because, again, it's not something that's easily accessible. And if it is accessible, it's under some very stringent and unfavorable terms many other times. So now we have a basic understanding of why companies raise money, the role that equity plays, especially in a Caribbean context. Remember, when this is not Silicon Valley, you don't just go down to the coffee shop and meet a billionaire and pitch a business. This is Jamaica. You're lucky if they understand your business model, and if they do, then just call them high net worth bridging, go up on the boat and copy a business model because of the pan chicken paradox. You're about to say something, Preston.
So could you give an example of a business that you're saying that some businesses essentially it's better for them to have debt financing, some businesses it's better for them to have equity financing? Could you give some examples of those type of businesses?
Okay, so there are businesses that generate very high levels of free cash flow, and it goes back to the cash flow statement. So free cash flow has to do with the relationship between operating cash flows and investing cash flows. What does that mean? Some businesses are more capital intensive than others. So it means that to get a 10% return, you have to deploy more money because of that business model. So for example, airplanes. The airplane industry, it's very capital intensive. You have to deploy a lot of capital to make money. Whereas you'd have a business that has very high turnover. For example, Fontana, where it is now today, it generates very high levels of free cash flow. So that business has a very high dividend capacity because of that free cash flow level. So what free cash flow is the difference between your operating cash flow and how much you need to reinvest to keep making money. So think about it as some businesses are more capital thirsty than others. So capital intensive businesses are more capital thirsty. The more capital thirsty the business model is the more it can take debt and afford to pay it off. But if a business has more capital thirst, it means that you're going to have a greater share of equity relative to debt to be able to generate profit margins that are attractive. So Lasco manufacturing, Lasco distributors, those businesses that have very high free cash flow, they can afford to take on more debt, and those businesses tend to borrow because they want to. But businesses that are very capital intensive tend to borrow because they have to. So before you invest, you have to always ask, is this business borrowing because they have to take more debt, or is it because they are doing it as an option. They just don't want the equity. They're taking it more as a choice or a luxury. So all of those things contextualize the type of capital that's being raised and not just necessarily the use of funds. You're in deep thought, Preston.
Yeah, I'm just trying to think about it because like the same example you mentioned, for example, last D, I know that I think they have essentially like no long-term debt or very, very little debt. And then I was thinking
that's
about
really a more recent thing. If you really track it from 2016, 2017 coming up, you'd see that these companies have maintained very low debt balances because they don't need it because of their free cash flow position. But businesses that have less free cash flow, they can't afford to run low debt balances. They have to keep borrowing because their free cash flow is negative. So they always have a funding gap. So they always need a loan to tide them over. Because
so that would be, for example, like I know, for example, renewable energy. That's very capital intensive, like
for
to
example,
do energy
or even
projects.
the
Like
company you love, JFP, they don't have it's capital intensive because those contracts take a while to come in. So they're going to need bridge financing and they're going to have to borrow to cover that bridge. But there are also situational issues that can arise because if you have a service business, some service businesses, because they don't have a lot of physical assets, they can generate high free cash flow if done well, if they're able to collect those contracts reliably and maintain their cash flow effectively. So what you find is that a lot of the onus on these service businesses is on management. So what makes or breaks the cash flow generating capacity of service businesses is how well management can manage those contracts. So for example, you have a business like One-on-One that has a challenge collecting the receivables. iCreate is another one that has an issue with receivables.
Edifocal, all of the ed tech businesses,
those receivables. But if those receivables were being collected and that cash was actually coming in, the free cash flow potential is very high. Those businesses could be running very low debt balances if they were actually collecting the cash. But there are some businesses, because the cash flow timing is so bad, or not ideal, I should say, it's not good or bad. Let's not color it. It just is what it is. Businesses have been cash conversion cycles. And sometimes when the cash conversion cycle is very long, you have to borrow more. That's another way of looking at it. Sometimes the cash conversion cycle is very short, so you don't need to borrow. So if you always think about it from a cash flow perspective, things make a lot more sense. Sometimes when
Suppose you have like high levels of like working capital, then you still wouldn't need to, as in, okay.
That's what I mean. So if your working capital is being effectively managed, which goes back to what we're talking about, your receivables. Remember, your working capital is your receivables and your payables, and the cash you have. So if those things are in the right balance, if your inflows are bigger or faster than your outflows, then you'll always have cash. Yeah. And that's positive free cash flow. So you don't need to borrow as much. Or if you're borrowing, it's because you want to. You want to have that extra cash as a backup. But are you borrowing more because you don't have the money? That's a different situation. So we'll have to talk about all of this before we start talking about the type of capital that's being raised. Because the type of capital you raise has to match your business model. We don't talk about that. Business, actually, investing is about capital. Profit is a means to an end. Profit is how your capital performs. But if you're not talking about capital to begin with, how are you contextualizing the type of profit you're making? You're not. You're talking about profit in a vacuum. And some profits are better backed by cash flow than others. That's why we talk about earnings quality, not earnings quantity. It's not how much profit you made. It's how much of your profit is backed by sustainable cash flow. Is the profit high quality? Is it real? Are you more likely to go bankrupt? So businesses that have higher earnings quality are less likely to go bankrupt than businesses that have low earnings quality. We don't talk about quality of earnings. And that's why I don't participate in some of these discussions. Because when you start talking about, talk about textbook and that not real and see them my profit go up and you're not here to joke. You're not here to joke. The business, you see, the business, first and foremost, is actually the balance sheet. The P&L is really just telling us how the balance sheet performs. Think about it that way. which is why we look at return on equity. It's how much did our profit yield in relation to our equity, because at the end of the day, the business is the balance sheet, and how the balance sheet changes is actually shown on the cash flow statement. So that's why since the start of this discussion, we started with cash flow, because cash flow is about capital and the balance sheet is just the snapshot of how your capital is doing. How is your capital as at June 18, 2024 relative to June 18, 2023? That's all it really is. And how it changed is shown on your cash flow statement. The P&L is just telling you how your balance sheet performed, but that has to be contextualized by cash flow because they're not the same. So now we can start talking about capital, right? In terms of what is appropriate, because sometimes entrepreneurs don't raise the type of capital that they need as it relates to the cash conversion cycle and what it is that they want to do. So for instance, if it is that I'm borrowing money that is short, so I'm issuing a note for 18 months, I have to ensure that either the business can generate that cash in 18 months or what I'm using the money to do can generate the cash in 18 months. That's another way of looking at it in terms of use of proceeds. So you can't have short capital projects that are long. You have to match your project life cycle with the type of capital you have. So long projects, long life cycle. Short projects, short life cycle. You follow?
Noted.
That's another way of looking at it. So even outside of the business model and the free cash flow generating capacity, also from a use of proceeds standpoint, if you're investing in something that's going to take long to pay off, you have to have the type of capital that allows that. So sometimes these things don't happen. And that's why when we put out investment recommendation to say, do not participate, people come out, oh, the man, them a fight out the thing. We're looking at all these things combined. We're not fighting out the thing. So, rights issue versus APO now. Let's talk about equity. Equity is hard to get. We said that earlier. I will mention some of the hurdles as it relates to equity. Now, when you're looking at a rights issue, you're effectively saying that you want to raise equity, but primarily from persons who already hold the shares. And an investor may elect to do that for different reasons. Maybe it is that they're trying to manage dilution. So they don't want to dilute the shareholders too much. And by doing that, you're giving the current shareholders the first right of refusal. You're allowing the people who already hold the shares to buy more in order to limit how much they get diluted as it relates to control. That's number one.
So
number two,
rights issue.
That's right, rights. The rights and the rights issue. Your shareholder
because
rights.
You have the right to accept or deny the offer, because some of them are renounceable and some of them are non-renounceable. So sometimes when you say you don't want to exercise your right to buy more, you now allow someone else to take up the right that you didn't exercise. Right? So the term rights issue is not arbitrary. It's a right that you have as a shareholder that you can choose or not choose to exercise. But as
I think of it as like an entitlement, like given to the shareholders.
It's a privilege. A right issue is a privilege. An APO is not a privilege. It's open to everybody. An APO is more democratic. But what the challenge with an APO is that by virtue of opening...
Why use the word democratic?
Because it's not favoring one group over the other unless you have a difference majority in price in the deal. So if you have a special class where you want to give current shareholders a discount, they can buy the shares more cheaply for argument's sake. But there's no inherent advantage from a participation standpoint outside of the price. The rights issue is primarily for persons who already hold the shares. If you don't hold the shares, you're not a part of the conversation.
You don't. Well, you have to hold the shares up to a certain date. So technically, they'll say the date is a month.
But yes.
They can say, okay, you have a month, and then you can become a shareholder, And then depending on the amount of shares you might be able to buy within that time, you may be able to participate more in the rights issue, or you are increasing your rights essentially.
Yeah, man, without a doubt. So that's even taking it a step further. But again, you had to be a shareholder in some way, shape, or form. An APO is just an offer. You can hear about the company for the first time and say, boy, I have equal entitlement to somebody who has been there from day one.
Yeah.
Right?
Yeah.
Just from the
exactly.
standpoint of being able to participate.
And sometimes the outside shareholder, sometimes the APO price is below market price a lot of times. And say the stock price is trading at 50, and there was a shareholder who bought at 50 and has been holding for say a year because the stock hasn't moved. The APO could come out at 40, and you as an outside shareholder are saying, hey, I can actually get in at a lower average price than you. So yeah,
that's deal. Yeah.
Yeah.
Usually the subscription price is usually set. I've never seen where the subscription price isn't set at a discount on
NCB?
That's what happened.
No,
with
like the
NCB.
day
NCB.
the day it was announced. I know the stock price usually falls, but initially I'm not well, I could be wrong, because NCB even 138 was very close.
No, it was below. It was slightly below. I remember. I think it was maybe 62 or something when it came out. Yeah.
Oh, well, there we go.
It actually had a slight uptick when the APO got announced.
But hold on, just before we start, we go into the case
examples
studies
and so on,
we just want to set the parameters first.
So yeah, there are a few things I want to also to mention, like because there are some stuff that I'm not entirely clear on, because you mentioned renounceable and non-renounceable, but we can go into it whenever you're ready still.
Yeah, man. So as it relates to the APO now, the APO is pretty much open to everybody. It's more democratic from the standpoint of anybody being able to participate. So the choice between the two has a lot to do with dilution, but there is a key piece of context that's not really mentioned when the debate is going on.
And dilution meaning
dilution
of the stake that you hold in the business. So what
the percentage ownership.
You used to own 20% of the company, and then now you own 10% because other people were brought in.
When new shares are being issued, right? When new shares are being issued, sometimes it results in the original shareholders having a smaller share of the business. However, the fact that new shares are being issued shouldn't be stated in a vacuum. If you're doing a cap raise, it means that the business itself should be bigger. So you have to always ask the question, are you holding a smaller share of a bigger business, or are you holding a smaller share of a business that's the same size? That shouldn't be. Really and truly, a cap raise means that your overall balance sheet is bigger. So that also has to be put into context. But in terms of the APO, there's an interesting nuance. So if we notice, most of the APOs happened after the end of 2019. And
JMMB's APO.
Yeah.
I think that was the first one.
If you look at it, it still was nearer to the pandemic, because the pandemic was like March, the first part of March 2020. So it would have just been a couple weeks, maybe maybe about 3 months. So right after, 3 months after JMMB's APO, the pandemic hit. And then right after that, many securities fell in terms of the market value. And the market itself hasn't traded the same way. The level of upside you could have gotten in 2017, 18, 19, you wouldn't be able to get it in 2020, even though there was still trading activity, especially on the junior side. It just was a totally different regime. There was a regime change. And most of the APOs happened under a softer market. So let's not put the chicken before the egg. Is it that APOs have underperformed in terms of price because new shares have been issued? Or is it because new shares have been issued, but the demand has not increased to match the supply of new shares? So supply has risen, but demand has either been the same or less. But at fall in demand for that security is not specific to the security, because the market itself, in terms of the majority of securities, have seen either smaller upside or overall declines. Look at how much stock prices have declined relative to 2019 right across the board. Even to, as a matter of fact, most of the companies that have seen declines in their relative stock prices versus 2019 levels didn't have APOs, because it is a broader market issue within the context of what the pandemic did to the market, of what higher interest rates did to the market, etc., etc. So it's a matter of when these APOs happen and not the fact that it was an APO. It's just the fact that all that supply was created while at the market level, demand was softening because of other factors. So it's just a matter of overlap. These securities didn't underperform because the APO took place. These securities underperformed because the market overall was underperforming as it relates to the majority of securities. I'm not saying there aren't securities that didn't do well over this period. They're always going to have that. But in terms of the grouping and the overall market performance, and even the upside that was experienced, it's still not comparable to 5 years prior because we're in a different regime. So are we really looking at it analytically to say these transactions happen in a vacuum? Is it that things have gotten worse as it relates to the tradability of these securities because of the APO? Or did this happen as a matter of what was going on more fundamentally, i.e. less persons, smaller average trading volumes, the market being less responsive to earnings outperformance, because there have been many companies that have outperformed in terms of earnings and fundamentally have done well, increase their productive capacity, reduce debt balances, improve profit margins, increase prices of their products without losing sales, and the stock prices that is, have not been moving in tandem with this. And it's because the market is softer. So are we dealing with a softer market, or are we dealing with APOs being problematic as it relates to post-APO performance? I just think we're putting the chicken before the egg, and it's really a narrative-driven thing. Why is it happening? I'm not sure. I haven't paid that much attention to it, but I just don't think the layers of what has really happened has been done justice. It's just a matter of, APOs are bad, because every APO that happened, the stock price fall. Many other securities saw lower stock prices that didn't do APOs. Are they bad? Even some of them that have gone on to perform better in terms of earnings?
Well, maybe, I mean, I think one argument would be that the timing is probably the factor, because it will happen even right after the APO, the shares actually hit the account, all share allocations are done and so on. And then you see a decrease in stock price. So that's also a counter argument. I'll also say that I wish we had more rights issues. What?
We just explained that.
More supply relation
the supply
in relation
came,
to the
but
demand.
the demand never moved.
But
no, but you're talking in a broader sense of no, wait. I'm talking about APO, like the APO effect that they call APO effect, meaning.
Yeah, we explained it. So
I was saying that. No, I agree, and I think we're both saying the same thing. I was just saying that you're saying it may not necessarily be due to just increase in supply of shares. You're saying that it also, just correct me if I'm wrong. You're saying that also there's just a softer market overall, so we can't really and truly see the effect. But I'm saying based on such a short time period, there are certain stocks where you can see it, where the APO will happen, will close, shares will be in people's accounts, right? And then you immediately see the stock just trend down. So I think there are some clear examples where you can see that APOs have had that effect.
Yes, but what we're saying, Thaon, is that the supply was created without any demand to match it. Remember, all prices are a function of demand. All of them.
Supply.
Yeah. But Julian, do you think that? Okay, so from my perspective as a retail investor, what I would say is that when the companies like the investment bankers see that, okay, we're going to be issuing these shares in a time where there might not be as much demand to soak up that liquidity or those amount of shares, right? So naturally, as you said, increase the supply without increasing the demand, the stock price will fall. And if I keep doing this and I say, okay, there was the APO that happened, and I do another one, and I do another one, or do another one, say it's not even the same company, but say I'm just the investment banker, do you think that is that then wrong on the investment banker side to say, I'm going to do this offer that I know will likely, the share price will likely tank, or it could contribute to the share price declining? Or should I, for example, try to find some other way for the company to grow? You know, like that's, I guess, one of the sides I think that if you know that there's reasons, it's not the only reason we're saying, but if you know that there is this reason that it could cause the stock price to possibly underperform or contribute somewhat to the stock price underperforming, should I then do that? And for example, have retailers put their money in, thinking, market to them saying, okay, this is really good. It's a good place to put your money. And then it's like the expectation that I guess some retailers have is that, hey, I'm going to make money in a year, 2 years, 3 years, but then these things happen and then, it doesn't perform. So I guess there's also that side, that should someone do that if they think that that could possibly, result in the stock price not performing?
Okay. So there are two things we need to look at. The first thing I would say is that, generally speaking, when investment bankers are raising money for clients, they do think about the attractiveness of the deal, but they're primarily focused with the client getting their money, because they get the fee based on the client getting their money. They don't do it necessarily because they want the stock price to rise. Remember, if the stock price is higher, you are creating more wealth for the client because the client is carrying that on their balance sheet. Their net worth is higher. But the transaction itself would have increased the client's net worth because the balance sheet is now bigger. So let me unpack that. If I raise an additional $2 or $3 billion for a manufacturing plant, that client's equity base is now bigger in real terms. So the transaction being completed has already made the client rich, even though the share price might fall in the near term. So there isn't a perfect marriage between, or I should say, especially as it relates to time period, and I think this is really a time period discussion. There isn't a perfect marriage between the near-term price fluctuation and how much the client's balance sheet has risen, because there's always a book value of shares and there's always a market value of shares. When a transaction happens, the book value automatically increases, and that increases the client's wealth in real terms. And you too, if you're a shareholder, yet the book value of the shares have gone up, even if the price falls. The market value might suffer, but the book value has gone up. So what are you really looking at? Are you giving the price a chance to surpass the book value, which takes time? Or do you expect the price to overshoot the book value in the near term? That might not happen in a soft market. So I'm just saying, philosophically, we need to ask a few questions. Let's put it that way. We need to ask a few questions. Do I have enough conviction in this company that I can shrug off a near-term fall in the price because of what I think it will do in a longer time horizon? So is this a chance for me to buy more and to average down? Or should I wait until the offer passes, make the price drop, and then use that as an opportunity to buy more? Because further down the road, I have conviction that management is going to create value and do all of these things to move up the price. That's another way of approaching it. So don't think of it as one-dimensional. Is multiple things happening at the same time. And as an investment banker, and I'm not championing it, if I can increase your book value, Preston, and allow you to buy the factory that you need to buy or go into the new market that you need to go into, I've done my job. I do have an interest in the uptake of the offer so it can be successful. So I need to be mindful of the pricing. But again, there are a few things. The last regime, or the regime that we're currently going through in terms of the market being softer, it didn't happen because of a textbook reason. It's a tail event. It's a pandemic, and then the pandemic followed by high interest rates, or higher interest rates, I should say, because interest rates in absolute terms are not that high, but they're much higher than they were 5 years ago. So much higher interest rates, and then many of us didn't expect interest rates to remain at this level for this long. So it's been a surprise to everyone, retail investors, investment bankers, everyone. Persons didn't expect to be having to deal with these trading volumes 2 years after a pandemic. Nobody saw that coming. And I think many transactions have suffered because of these unique circumstances. So I think it's more so the uniqueness of the circumstance as opposed to saying, boy, we're just going to do more APO, even though the price dropped. I don't think they necessarily wanted the price drop. They want them clients to be richer. And you are the client too. But I'm just thinking that once the client gets the money and their book value is higher, then they can now deploy that money according to the prospectus and create wealth for you in the next 2 to 3 years, because these projects take time to materialize. What does that mean from a trading perspective? You might have to dodge the bullet, allow the price to drop because market conditions are softer, and you use that as a lower entry point to purchase. So that's another way of looking at it. But hopefully, some of what I shared with you just added a different context to it. I'm not saying it's right or wrong, but I'm just showing you the thought process. Now, as a buy-side professional, I'm not a sell-side professional, so I don't raise money for clients per se. I'm more looking at it from the standpoint of, okay, I am stewarding clients' capital. Are we making a investment decision that benefits the persons we're investing on behalf of? So it's a different thing. There's buy side, sell side. So I'm buy side. I'm always thinking, is this deal fairly priced? Is the risk of the deal fairly communicated? And is that being carried in the offer price? Because the offer price is not just telling you how much money is being raised per share. It's really supposed to be giving you a deal in the standpoint of, okay, if this share or if this stock was to decline in value, how much downside can I tolerate? It's something called margin of safety. Is this deal giving me adequate margin of safety? Are you asking me to pay 2 times what the company is really worth from an accounting standpoint? I can't be paying for something that is not in a good position for twice what it's really worth. I'm not paying 2 times book value for something mediocre. You have to give me a discount. But if something is doing well, I might be able to pay a small premium. I might pay maybe 20% more, 25% more, 30% more. And even if you're asking me to pay double, why am I paying double? Is this a landmark, revolutionary piece of technology like AI? And what kind of AI is it? And are you a leader in that space? So that's really where my head is as it relates to analyzing deals. Because sometimes you might have a good deal, but the price is just not right. The price does not justify the risk. The risk is here, but the price is way above that. I can't justify that because it's not my money. I'm making an investment recommendation for money that's not mine. I have to protect that money by looking at downside risk. Because if the risk and the price are out of whack, it means that I am now opening that client to a lot of downside, because everything is a matter of odds, and I have to
be
find
a client for long.
Right, exactly. Boy, a lot of what I'm saying is in principle, but what actually happens as it relates to how those decisions are made is a little different. But because I run my desk, I have to ensure that I can defend what I've done. What happens after my submission is a totally different thing. But at the end of the day, you're doctors. You understand what it is to have standards and to make a promise to clients to say, look, you trust me on a certain level. I have to do good on the trust that you have reposed in me. That's the same principle. So how much downside protection am I giving you, or how much downside protection is being offered in the deal? And is it justifiable? What's behind it? Those are always the questions that I am more concerned with. So I'm not just concerned with the fall off in the price in a vacuum, but how much of a premium am I really paying relative to the value that I think is going to be created in the next 2 to 3 years? It's always a balancing act. Am I being lied to? Is this reasonable? Is this a once in a lifetime deal? And if it's a once in a lifetime deal, am I being ripped off in terms of the pricing? So the issue I had with 138 was the pricing. The pricing wasn't justifiable. So let me give you some context. When you look at the balance sheet of 138, and that's why I keep talking about capital and the balance sheet, most of the balance sheet was the value of the contract with UA. The real estate is actually not on the balance sheet. So 138 does not own those buildings. 138 owns the right to operate those buildings. And that right, which is the contract, is valued using a discounted cash flow model, which we can't see. But that's fine. It is what it is. Yeah. The bulk of the balance sheet is actually the financial asset service commission rights. That's what we're talking about. The bulk of it is actually that contract. But the contract is actually not available for public viewing.
Even in the prospectus, it wasn't there?
It's not available. There. Even if you look in the audited financials and there's a note, you can look at that note and the note is saying those contracts are actually not available for public viewing. So what I'm saying is that if you are going to add that level of opacity, or if you're going to limit transparency at that level, you cannot offer me something that is not at a substantial discount, because I'm taking a significant risk. I'm investing in something I can't see. Yeah. You have to give me a discount. And that was my point of contention with 138. It wasn't at a discount, or not at a discount steep enough to justify investing in something I've never seen in my entire life. I don't even know if I'm being lied to. So those were some of the issues I had. And then in terms of free cash flow,
there's a time period for that contract. Like I think is it 50 years or so on? But as you said, no one has really seen the contract.
You're not allowed to see it. You're not allowed to see it. And then my other problem is that the most valuable asset to me is the buildings. Who owns those buildings? Why isn't it that the listed entity doesn't hold the most valuable asset? Why is it that the listed entity holds the right to operate the asset, which is under a contract that can't be seen, but the actual real estate, which revalues every single year and appreciates in value, is not on 138's balance sheet? So in other words, the true economic value is not being offered to us. Because if they held those properties, they could borrow against those properties as fixed assets and get a lower borrowing cost. Because if I can borrow against hard assets, i.e. property, plant and equipment, like student housing, it means that my interest expense will be lower.
True.
Because it's just like taking a mortgage. I can borrow against those high quality hard assets and lower my interest expense. But if I take the properties off the balance sheet, it means that all I have is a contract. And that contract is not a physical asset. It's an intangible asset. And the borrowing rates for intangible assets is higher. So you're literally putting the business in a funding challenge, because the type of capital you have doesn't match the type of assets. 138, in terms of its capital structure, was not set up properly. If you are going to make the majority of the balance sheet an intangible asset, the bulk of your funding base has to be equity. Because debt most favors tangible assets in terms of collateral. So in other words, if you were to go to a bank, Preston, and say to the bank, boy, I don't have no machines or no ambulance or no vehicle to give you a security, but I get a guarantee from one of my business partners, one of my counterparties, to say that they're going to buy from me, and I want to use it as security. You can use it as security, but the terms are going to be less favorable, because it is the physical asset that de-risks the undertaking to a greater extent than a promise.
Because you could easily sell it. Like if it's a car or something, you could just say, okay, if the defaulted, the bank could just...
You can see it. Meaning you can touch it, feel it, you can transform it, you can enhance it, you can expand on it, you can exchange it for something similar. It's hard to do that with a contract, especially a contract you can't see.
So
now
and they were using the APO, I think, they were using the APO to pay down on debts, right? I think that was a big part for them.
Yeah, but what we're saying is that even from inception, if you look at the IPO and the capital mix didn't match the business model. If it is that the properties were on the balance sheet, fine. But if you're going to take the properties off the balance sheet, then most of your funding base has to be equity. So the funding mix was wrong off the bat. That's why they were always in those cash flow problems for so many years, because it was too much debt. The same problem happened with GUS. Even though GUS has more physical assets on its balance sheet, the funding mix of GUS was still wrong, because GUS was a startup financed mostly by debt. GUS should have had mostly equity. So the funding mix for GUS was wrong. That's why I tell you guys, focus on capital. It tells you a lot. So for you to try and offer me, right, an APO on something that had the wrong funding mix and the bulk of your balance sheet is something I can't see, you have to give it to me at a steal. It don't make sense. So it was a discount to book value. But what is a book value? The book value is a contract, which I already gave you the issue of lack of transparency. So we have to look at it from an earnings standpoint, because the cash flows are unstable. Can't use a cash flow valuation model. Can't use a book value valuation model by itself. I have to look at earnings. And from an earnings standpoint, the discount just wasn't appealing. It wasn't enough. It was priced too rich.
So you're using it. So you're giving an example of the bank. Same thing with the bank, to make it more
intuitive.
So the bank is saying, so I'm going to the bank. I do have a car. I'm saying, okay, could I leverage whatever the person that owes me money? They're going to give me a much higher interest rate. It's the same thing you're saying, that risk is matched to the interest rate.
Yes, because it's a lending principle. So the earlier example that I gave Preston about you starting a business and going to a bank would apply to bondholders. And in taking it a step further, equity holders would have to bear that in mind as well, because remember, debt is paid before equity in the capital stock, So if you're levered up and you can barely afford to pay that debt back, and all of those debt holders are ranking before me, and I'm further back in the capital stock, you have to compensate me for that risk. And at the same, I'm going to go back to it again. I'm not only sitting far behind in terms of leverage, i.e., you have all this debt that comes before my money, i.e., the equity financing that I'm providing, right? I'm way behind in terms of priority. But the bulk of the value that I hold is on a contract that I can't even see. There's a big problem with that. If you're going to do that, the price has to reflect it. That's all I'm saying, If I'm taking on so much of a headache, the price has to carry the headache.
So was there a price, for example, that you'd have been like, okay, I think the APO was like $4 or $4.10, something like that? So
yeah,
is it
but
like
I
you
think
worked
my recommended
out
price was like 2 and mash. I don't remember off the top of my head because I did that
something like that
from before. It was 2 and mash though. Like
I guess the tough part though is that when it had announced, the stock price was like $4. So then if they say APO, say for example it was $2, the APO is at $2, then it's like the stock price. Anyone who bought, like the same thing we're saying, logically it makes sense. If I bought at $3, if I bought at $2 from before the APO and I've been holding, and you are telling me you can buy all units you want at $2, the natural response should be to sell. Because then you should say, okay, if I bought at $2, it's at $4 now, and I could sell at $4 now and then buy back in at $2, I'm just going to sell. So then it's like the selling pressure, I think, would push the price down. And then you could see a point where one rate is dropping 50%.
And even if you don't sell, because I know you mentioned, you could possibly just hold and average down and so on. But a lot of people would still sell and there would be no buying pressure at that price. Because if you can get it for $2, why buy it for $4?
Especially in a market that's soft. But I'm just gonna bring back the.
No, I feel like that's in any market. If you're offering these shares at a 50% discount in an offering, whether it's a bull market or a bear market or so on, I feel like demand would be so small that you'd have a tiny portion. I mean, why would anyone buy at $4 then? You get me?
So
there's no
so
incentive.
You're just saying the bear market would make it worse. So if it's like a huge offer and it's a bull market, maybe if there's tons of pensions who want money, they might say, okay, I'll put money versus.
correct.
But at the end of the day,
They would
You
create
probably wouldn't get to your units then.
they would
Is what
create
you're
a
saying.
higher price floor. What I'm really saying is that the market cycle that you're in, it determines your level of upside and your level of downside. So in a bear market, your downside can be much greater and your upside tends to be less. So the way you assess risk in a bear market is different, which is why I was saying, especially in a market that's soft, because as Preston said, it's just exacerbated by the type of cycle you're in. But what I wanted to share with you, Thaon, is that there's the theory that if it is that I'm looking to pay off my debt and I want to use a business to build more rooms, the benefiting from more rooms is something that happens over years, It's not something that happens quickly.
Yeah.
So if I build those rooms and those rooms become occupied, that's going to take a couple quarters well to even materialize. So that might happen over the next 2 to 3 years, give or take. The theory is that the value that you would create in 3 years would be so much greater than the temporary hit you would take from the transaction right after listing. That's the theory, and that's the thought process, and that is what is being sold. But I always ask the question, knowing why you bought always justifies the case for selling. So let's stop talking about securities for a little bit and let's think about it like dating. The reason you talk to a sister has a lot to do with your capacity to leave her. If you were just linking her because she looked good and you just meet her and you just wanted to see where things go and you don't know much else about her, you're far more likely to stop replying than is a girl you know for the last 10 years and she's getting on top of your nerves, but you really want to build a life with her. So your capacity to tolerate certain things is totally different and it's justified by why you were talking to her in the first place. Same thing with securities. If it is that I wanted a trade, or I don't feel that strongly about it, or I just wasn't looking that far because I'm not that interested, then fine. How you treat an APO is colored by that. But if you have a certain level of conviction, even though your near-term downside might be unfavorable, the downside will have a different context. You will want to average down because you had the intention of holding it for 5 years anyway.
I guess it goes.
So
that,
again,
I guess
it's
that
just a
makes
matter
sense.
of
No, you're
why
right.
you bought to begin with. That's
Your
where you need to
timelines, your
start.
goals, those kind of stuff. Yeah.
Which is, and all of these factors is why I keep on saying the APO is a means to an end. The APO by itself is nothing. It's just a means to an end. The APO is just a vehicle.
Well, can I ask a question then?
Yeah.
The fundamental difference, because a rights issue and APO are very similar in most senses, but the fundamental difference, because you're still raising money, creating new shares, all of those stuff, right?
Yeah.
But the fundamental difference is just the shareholder rights.
Right.
From the I guess I know a lot of this conversation we're speaking from the investment banker side, but I want to ask, why then do an APO versus doing a rights issue? Is what's the aversion to doing it? Because personally, I haven't seen a good rights issue. I know Key has done maybe a rights issue, I think in 2020. I don't really remember the parameters or what happened then, but since I've been investing in 2019, I have not seen a good rights issue, and there have been way more APOs than rights issues. So I wanted to know, is there some reason for that? Is there an aversion to doing it? Is it way more complex?
Well,
what is it?
well, what happened? What happened? Thaon, is that